Hey guys, this is Will Taylor with Anchor Real Estate Advisors. In this video, I'm going to be discussing two key components of real estate today. I'm going to be joined by my friend and preferred lender of over 3 years, Matt Qualiana with Homeowners Financial Group. Now, let me tell you a little bit about Matt. He's been in the industry for over 20 years. He serves all types of clients from lower income to higher income, does all sorts of lending from home ownership and primary residence to investing in second home properties. And in addition to that, let me tell you one thing about Matt and I. In over 3 years of working together, we've never had a home that didn't close, and we've never had a home or a deal that fell through because of anything that Matt or his team done. So when you listen to us today, you can trust and know that you're getting great expert advice from real estate professionals. Guys, dream bigger. Think beyond where you're at currently right now. You're not crazy about the money that you make right now. We all want to make more money, but maybe you're clocking in 9 to 5. You're making what you consider decent money, but you have all these dreams, you have all these aspirations, you have all these ambitions. Guys, what if all that started with one call to me and Matt and your real estate professionals, and we lay out a plan for you, and in 5 years from now, you're sitting here coaching people, telling them the exact same thing because all you did was make a call. Before you do anything else, please make sure to like and subscribe to my channel, Your Way Home, for all your advice for real estate investing and home ownership. So let's talk about the market in 2024 in Georgia, more specifically North Georgia, where we are today. There's so many of you out there, you're stressed. You're looking at the economy, you're looking at world affairs. It's an election year. Are rates ever going to come down? If so, when? Are they going to go up? Should I buy? Should I rent? All relevant questions that we want to tackle today. Before I ask Matt some more financial questions, let me just give you a general idea of a couple, hot spots in the North Georgia area as it relates to the real estate. So in Canton, Georgia, where we're actually at right now, the average sales price in March of 24 was $560,304. That is a 13.8% increase from this point last year. Now, what's interesting about that is rates have not really done a whole lot, right?
Yeah, generally they've been pretty much the same, fluctuating from about a year ago, I guess.
Yeah, and so, guys, a lot of you, you say, well, I'm going to wait for rates to drop, or I'm going to wait for this to happen or this to happen. But guys, compared to where you were last year, and oftentimes Matt and I'll have him run something that's called a cost of waiting scenario. And if prices have went up 15%, but rates are the same, that's going to make your payment a lot higher.
That's right.
Yeah, I mean, so, and guys, we're not talking $50. We're not talking, it could be several hundreds of dollars. So matter of fact, and you might be saying, okay, well, I'm just going to rent for the next year. I'm just going to continue to rent, and I'm just going to play that game. Well, Matt actually has a family member who works in that space. And what were you saying the other day? Like an average 3-bedroom apartment now is like $3,000.
Yeah, she was telling me it's almost $3,000 a month for a 3-bedroom apartment.
Yeah, and see, guys, and $3,000 a month, while that seemed astronomical, even with the rates kind of high, I mean, that can still get you, depending on your down payment. I mean, that still gets you what? I mean, at least somewhere between probably a $450,000 home or so.
Yeah, depending on the situation, that's a pretty good estimate on what a payment would be on a sales price like that.
Yeah. Well, and so Matt, because obviously this is your area more than it is mine, what do you think as far as 2024 with everything going on? Like I mentioned before, you've got all these world affairs, it's an election year, you've got the economy, inflation. What do you kind of see happening over the next 6 to 12 months?
Boy, I tell you, I wish I knew the answer to that, honestly. If we go back to the COVID era, everything that's transpired since COVID, I've been in this industry 23 years, never seen anything like this. Inflation is higher. You guys can attest to that with everything that you have to buy on a day-to-day basis. So, we're feeling the effects of what COVID brought us, right? It's lasting longer than we anticipated, lasting longer than we thought and hoped for. So to answer your question, the crystal ball, what do we think is going to happen? Well, if you asked a couple months ago, we kind of had a game plan. We talk about the Fed's raising and lowering rates. That doesn't really have anything directly to do with mortgage rates. It's really tied to inflation. And as inflation is stagnant now and actually starting to rise just a little bit, that is really the problem. That's what's causing interest rates to maybe fluctuate a little bit higher, certainly stay.
Well, and just to speak to this, because I've had some of you reach out to me and you said, well, I want to wait till rates get back down in the threes and the twos. I mean, realistically, Matt just used a key word there, artificially low. Matt, the prospect that we're going to see rates in the twos and the threes again, that's probably a pretty low probability, wouldn't you say?
Yeah, unless there's, major government intervention or war, things like that. That's generally when things like that are happen again, government intervention usually. But no, I don't really, at least anytime soon, see rates going that low again.
Yeah. Well, and guys, to the stat I just gave you a minute ago, we understand the hard spot that you were in. I mean, Matt and I were talking the other day. The last time we've seen a house payment under $2,000, $2,500 a month, it's been a minute. And we understand that, depending on your income, I mean, that may be a very tight squeeze for you financially. But what we're trying to tell you is rates are staying kind of the same, and they're not coming down right now, but prices are continuing to rise. So if the prices are continuing to rise while rates are staying relatively the same, what do you think is going to happen when the rates do come down? The prices are going to soar even more. So common saying that we've been saying over the last couple of years, marry the house, date the rate. If you're going to get a better deal on the house, it's probably going to be right now when rates are, a little bit higher than desirable versus when they do come down. So you can always refinance. There's options. But if you're going to pay $3,000 a month to live somewhere, why not own a home and have equity and wealth built in that home?
That's right. It's kind of a pick your poison situation that we're in right now. Low rates, low home prices. That's ideal, right? We'd love to have that. Well, we've exited that scenario. Now we've got higher rates. Home prices are continuing to rise. There's only, I think, 6 times in the history of measuring what home prices do where they've actually declined. And I believe 4 of them were around the Great Recession. So that just kind of gives you an idea of what home prices do and are going to do. Now, when interest rates come down, at some point they will, exactly what Will was saying. The home prices are going to go up. There's going to be more buyers. There's going to be more competition, if you will, in the market, and kind of will be more expensive, right? Because the sales prices will be higher. Now, those that already own a home get the benefit of the equity that they build up. So it's one of those where home ownership has been, and will be a fantastic wealth building machine. And it's certainly been evidenced in the last few years.
Well, and guys, also, and I forget the exact number, Matt, you may know, but there's a very high percentage of buyers in the 2020 era, when there was multiple offers and, that kind of stuff. The rate of buyer's remorse was through the roof, because what was happening is, the rates were low and we were all excited, but somebody was coming in just trying to land a house and they're throwing $50,000 over asking. They're taking the house as is. They're offering appraisal gap coverage. Like they're throwing everything in the kitchen sink at it. And then they get out of due diligence, or maybe they even close on the house and they're going, wait a minute, I don't feel real good about the deal that I just made. So guys, like Matt said, pick your poison. And we hate to use that word poison, but we're trying to be honest with you, trying to be truthful with you. At the end of the day, it goes back to the question that I asked a minute ago. If I have to pay $3,000 a month to put a roof over my head, would I rather put it in something that's 100% interest? Something that I can't make any money off of? Or would I rather invest it in something that down the road can build my family's wealth, possibly generational wealth, and can ultimately set me up for greater success?
Yeah, absolutely.
So we've ran you through a very general, market analysis, what we think, but let's talk about real quick getting ready to buy a home. Now, we just came out of tax season. It's the hottest time of the year, but maybe you guys are hearing what we're saying and you're saying, you know what, I don't want to pay $3,000 a month for an apartment. The idea of paying $3,000 a month for a 1,200 square foot apartment, is just, I cannot swallow that. So I want to buy a house. Matt, what would you say are some very simple, kind of elementary rules of getting prepared to buy a house, as far as credit, having any money saved, those kinds of things?
There are three things for purchasing a home. It's credit, income, and assets. I mean, it's really that simple. Monitoring your credit, keeping your what's called your debt to income low, and then as far as your assets go, what you saved up, what you have available can be 401k, it can be IRAs, it can be stock stuff, it can be checking savings, it can also be a gift from a family member. Those are really the keys to qualifying for a home. It sounds as simple as that, but that's really the three keys.
Yeah, and guys, one mistake, and I know Matt will take me to lunch after this for saying this, but one huge thing that is very important is we understand you guys are trying to do what you think is best to build your credit. So our knee-jerk reaction as just the basic consumer is, hey, I just got back my income tax money, or I just sold a car, or whatever it is, I just came into some money. Hey, you know what? I'm getting ready to go buy a house. I'm gonna go pay off that credit card, or I'm gonna go pay off that loan, or I'm gonna go do this or do that. Oh, that'll boost my credit. That's not always the right thing to do. So we've ran through kind of a general analysis of the current market, and maybe you're getting ready to buy a home and you don't want to pay $3,000 a month for a place to rent anymore. So what is the next step? Will, I'm ready to buy a home. What are the next steps? Well, there's really not next steps, plural. There's really one step. And what is that, Matt?
Well, the first and only step should be getting pre-approved. And that's talking with me. Whether you're buying now, a year from now, 2 years from now, it's always a good step to talk to the financial side of it and see where you stand. So even if you think you're in the best position, that's my job. That's my job to point you in that right direction.
Well, and so to speak to what Matt just said, I mean, you may be hearing that, you may think, oh yeah, of course he wants me to apply because he wants my name and number so he can bug me like all the other, 1-800 numbers that call me. Guys, first of all, we are not those people. We are not the salespeople that are going to harass you and bug you 35 times a day. The reason Matt says that is this, because as a basic consumer, all we look at is I've got a bill or I've got a debt and I want to pay it off. Theoretically, if I pay it off, it should make my credit go up. So what a lot of times happens is somebody will say, well, I'm not going to apply yet. I'll do that down the road. I'm going to go ahead and take care of X, Y, and Z. And then what happens, guys, is you use the cash you have available to go do what you think is the right thing to do. You finally do come to Matt on the back end of that. And then, what happens is Matt's actually got worse news for you, because sometimes paying off stuff and doing all that is not the right thing to do.
Yeah, credit's very tricky. Most consumers have access to, Credit Karma and those online resources. And I'm the bearer of bad news that is not what we on the mortgage side refer to. So while it's a good starting point, it's not what we use on our end. And certainly some of those things that show you, some of these credit services and so forth that will tell you what to do. You have to pay money for those. We do all that for free. And that's part of our service. So, we'll set you up with that. Same thing that you would get by paying, tons of money to get in one of those programs. But while it's good to monitor your credit through those avenues, what we use on the mortgage side of it is different. And we'll give you a better idea what's required.
Well, and guys, the other reason that's important is, so many times this is what happens is somebody will call me and they're like, hey, Will, I make X amount of dollars. I've got great credit. There's 4 houses this weekend I want to go see. Let's go see them. Well, guys, I'll be honest with you. I know very elementary information as far as the debt to income ratios and, conventional requires this, FHA requires this, but I don't know those like Matt does. And so, and if I don't know those like Matt does, then there's probably a pretty good chance you don't know all the ins and outs of all that either. So you may think you qualify for a $600,000 house. And so if you're not pre-qualified, what's going to happen is I'm going to take you to that $600,000 house and we're going to spend time, we're going to spend money. Your wife's going to, or your husband's going to love that home and they're going to fall in love with it. Oh, baby, this is the next home. You're going to apply with Matt and then you only qualify for $450. Now, guess what? The whole experience now is just a complete crapshoot. Why? Because the wife's already disappointed or the husband's already disappointed because they didn't get their dream home. Now you feel down on yourself because you thought you'd qualify for a lot more. Guys, it's all about expectations. So it's important to start with Matt and start with that application so that those clear expectations can be set.
Yeah, because I don't want to be the bearer of bad news when you get excited and look at home before that. So we want to put you in the best position so that right off the bat, you know. Plus, and you can speak to this, is if there are multiple offers, and you know, it's good to have a
true pre-approval
that you can go in there strong offer.
Yeah. Well, and guys, on the flip side of that, you know, we're using the scenario, well, what if you don't qualify for as much? But there may be scenarios where you qualify for much more. Matt and I had a client a few years back that, very modest guy, came from humble beginnings, and when he initially started, they were looking for land in the $400,000 or $500,000 range, et cetera, et cetera. Well, they apply with Matt, and much to their surprise, Matt actually says, hey, you really don't have a budget because you're sitting so well, you could really go buy your dream lake home if you wanted to. And they were just blown away because they just didn't realize the kind of good shape they were in. So it can work to where you don't qualify for as much as you think you would, but it can also work to where you could actually qualify for a lot more. You may be able to get a lot more for for where you are than you think.
That's right. Yeah, you can. The other side to that is, income can be what we like to say variable. And what I mean by that is you maybe get a base salary, you get commissions or bonuses or, things like that. Depending on how long you've received those, we may not be able to use all of those. It just depends on the product, right? So, if you're commission based, well, the rule of thumb is 2 years. You got to receive that for 2 years. So if you're just now starting to receive commission, we might not be able to use all that money. So those are the kind of things that we really dig into and make sure that you're set up for success and what you can afford before going in. Yeah, the other side of that is one of the hardest ones, and I don't mean that in a negative way, but one of the more detailed ones is self-employed individuals. And rightfully so, self-employed individuals write a lot of things off on their taxes, right? Well, we kind of look at it the same way the IRS does. As far as income goes. Now, that could be the negative side of it. You make X, but you only show Y to the government. However, there are alternative products that are available for specific self-employed people where we can actually show more of the income because there's actual income coming into the business, and we can use it that way. Again, this is all stuff that we have a lot of experience doing and do this stuff every day.
Well, and guys, to Matt's point, that's even another reason to apply early, because let's say it's November, December, and what you guys tell us all the time is, well, I'm not going to buy right now. I'm going to buy in the spring. How many times do we hear that, at the end of the year? Well, guys, while Matt is not a CPA and can't give you tax advice, it wouldn't be bad. I mean, it'd actually be beneficial to still go ahead and apply, because if you're planning to show a loss, or if you're maybe that initial conversation with Matt, hey, I'm thinking about buying in 3 or 4 months. If I file my taxes this way, how is that going to affect my ability to buy? So he's not giving you tax advice, but he can help kind of guide you as far as, hey, if you do that, yeah, you may not have to pay Uncle Sam any money, but it's going to hurt you when we actually look at your stuff and you apply. Yeah. Well, and so guys, I mean, Matt and I both, have been around this general area for a long time. Matt is a Buffalo Bills fan, so don't hold that against him. We're the Dirty Birds down here, but he's lived locally for a long time. I've been born and raised here, so our network of people, from financial consultants and advisors to CPAs to in-house credit teams that actually specialize in credit repair and all that stuff, guys, we've got all those resources for you. And like Matt said earlier, it's free. You don't have to go pay some consulting company. Matter of fact, those can actually hurt you, right?
That's absolutely right. They can. It'll drag on and drag on and drag on because remember, they're making money.
Guys, at the end of the day, the important thing to know is beyond just selling a home, my broker with Anchor Real Estate Advisors, one of his favorite things to say is it's about more than just real estate. So guys, when you apply with us, when you talk to us, our goal is not simply, hey, we want to go buy you something so that, we can make money or, do our thing. Our goal is, how can we serve these people and set them up to build wealth and to be more successful in the days moving forward? Keep that in mind and reach out to us. So guys, one of the fears when you get ready to buy a home is, okay, Will, I get you, Matt needs to see this and Matt needs to see that. Yeah, I get you. But Will, I don't want him seeing my credit report because, Will, there's some really embarrassing stuff on there. Well, guys, think about Matt as almost kind of like a loan doctor, if you will. When you go to have a physical every year, none of us like getting in the gown. None of us like exposing our most vulnerable parts, as we would say. But think about that as in terms of, hey, I've got to do that because if there's something wrong with me, even if it's embarrassing, I would rather know so that I can take care of it if there's a problem. Think about Matt as a loan doctor, if you will. You may have to expose some of those things that you may be ashamed of or have issues with, but the only way to get them fixed is to let somebody that knows what they're doing take a look at them.
That's right. I'm not going to do a full body scan or anything. I just need a driver's license in that regard. But
yeah.
But yes, absolutely. We'll dig into that, and trust me, I've seen it all. We've seen the worst, I've seen the best, and everything in between.
And guys, let me alleviate your fear with this too. When I used to work in the medical field, and that's why I use those metaphors, people would always say, "Yeah, I bet as soon as y'all walk out of the room, all y'all do is make fun of these people and talk about these people." And guys, the truth was that's not what we did. We were there to serve. We were there to help. Same with Matt. He's not pulling your credit app and then going to the loan officer next door and saying, "Oh, can you believe these people? They ain't got no money." That's not how they work. He's here to serve you. He's here to. That's the whole purpose of his job is to help you be set up for success to buy a new home. So I promise you, when you apply, Matt's not getting on the phone with me and saying, "Oh, Will, can you believe these people have this on their credit or have this?" Matter of fact, he can't even share that stuff with me.
That's absolutely correct.
Yeah, I mean, guys, we've been working together for, the better part of 3 or 4 years now. And guess what? I've never been given somebody's income. I've never been told, "Oh, so-and-so has this much in the bank." I've never been told, "Hey, can you believe that Mr. Smith has 4 bankruptcies on his credit?" None of that sort of thing, guys. Just like it's private between you and your doctor, to fit the metaphor, it's private between you and Matt as the lender.
Yeah, 100%. There's rules and laws against that, in fact. So we aren't going to share that anyways. Yeah, and this is exactly why we're here to help you and get you through the loan process, get you to the finish line. Because there's 2 happy parts of the loan process: the initial part, right, when you're excited, the closing, and then what our job is in between to make it just as smooth.
So another sect of the real estate market that Matt and I do a lot of work in together and even apart is real estate investing as it pertains specifically to the short-term rental side. So in previous videos that you guys have watched, we've gone through Blue Ridge and North Georgia, and we've gone through what some of those areas look like on a very basic level. But let's take a moment and just kind of delve into that from a more financial, numbers-driven perspective. Most of you probably watching this segment, before you just scroll on, listen, because you may hear real estate investing and you may think, well, I don't make enough money. There's no way I could ever own a second home or, investment property. But Matt, you don't have to be filthy rich to be able to obtain a second home or an investment property.
No, not at all. In fact, if we're talking about a second home or an investment property, odds are you already own a property, right? So maybe there's enough equity in that property to use to purchase your first or other investment property or second home. So that could be an avenue right there.
Well, and those loan types are totally different, whereas if you're just buying a primary home, there's all these debt to income ratios, there's this, there's that. A lot of these investment loans are a lot, I don't want to use the word looser, but they're a lot...
less documentation. Yeah, there are.
All the debt to income stuff may not necessarily be...
Yeah, it's all based on the property. It's based on what the property is going to bring in rental income compared to what the mortgage payment would be on that property. So there are literally investor loans that are strictly for that. So that's the expert side of us to kind of point you in that direction on what property generates income compared to what on our end what that mortgage payment would be. So could be a very sound investment in that sense, and less documentation, a lot easier point of entry, I should say, to get into that investment side of it.
So let's run through a very basic example. You'll recount in a previous video where I told you in the LJ Blue Ridge area, a good entry-level cabin, and when I mean entry-level, I mean it's not anything very luxurious. It's not, a fixer-upper, but it's kind of a modest turnkey cabin. You're going to be in that $600,000 range, give or take a little bit. We talked about that again in a previous video. So guys, as I said, these investor loan types, they're not near as stringent as you might think, and it's a lot easier to qualify for them than you might think. So let's say you're sitting there and you're watching this video, and you've got a couple $100,000 in cash, either in the bank or in various sources, and you want to invest. Well, the point of entry for one of those cabins is about $600,000. And so on average, that cabin's going to make you about $60,000 in gross income. If we divide that over 12 months, that's $5,000. So what are the chances that we could probably make that work from a loan perspective?
Yeah, it all depends on what you invest into it, meaning what you put down, as we talked about before, credit, what your credit is, what you have invested in, the asset portion of it. So if we've taken $120,000 to put down, right, $600,000 house, $120,000 down, that's 20% down. That's a good starting point, generality there. The idea is if your mortgage payment, right, is $5,000 or preferably less, and it's bringing in on average $5,000, well, that's a pretty good investment on its level right there. Of course, anything lower that you're paying in monthly payment is just a little bit of profit to you, and that fluctuates as well. So that's what we look at. That's how we look at the investment properties. It's all based on that property and what that property is going to generate. So we have, the process with that is we have appraisers that go out there. We do what's called a rent schedule, based on similar properties in the area. And then of course, what you're putting into the property and that kind of thing. So the next level to that is if you're getting a 30-year fixed mortgage on that property that's fixed over 30 years. Let's say you don't even touch it, don't refinance it, just keep it for 30 years. The idea with investment property is rents go up every year, your appreciation goes up every year. That 30-year payment stays about the same, right? Taxes come into effect sometimes, but generally they stay the same. It's almost a double profit that you're making right there.
Well, and guys, that's one thing to keep in mind, because when we think about investing, we think immediate money making, right? We think stock market. We think, I'm immediately going to make a return. But guys, the thing is, like Matt was just saying, even if you're breaking even, or hey, maybe you have a good income and maybe you're even falling a little short where maybe it is, $200 or $300 a month or something like that short, you got to think about the long-term gain of that and the appreciation. This is kind of a unicorn situation, but Matt and I actually recently had an investor who bought a home, and guys, literally within, a matter of 45 days or so of owning the property, he was offered an amount that was almost double what he paid for the property. So we're thinking 15, 20 years down the road, guys, for all you know, somebody could come along 6 months from now and really want your house, and you could double your investment, that way. So try to keep in mind the long game and not just the initial gain of it. And as your real estate professional, guys, it is our job to go hunt those properties for you. So you might be saying, well, I don't know, should I buy a cabin in the woods? Should I buy something on the water? Should I buy something with a view? Does down a gravel road matter? What if it's a modern cabin? What if it's a rustic cabin? Guys, those are all things that I'm here for. In addition to that, I have tools at my disposal. Matt has things at his disposal where you can actually run projections on that cabin based on measuring tools and measuring rods that are out there. So guys, you're not walking this alone. You've got me on the side to help find you the thing that's going to be very marketable in the future, that's going to be very appealing to future buyers. You've got Matt on the other end that can give you the financial perspective.
The other side to that, while I'm not a CPA, as a mortgage advisor, for those that might be new to investing or even those that are professionals at investing, there are many tax benefits to owning investment properties as well. So, again, that's for a financial planner or CPA professional to go over those in detail, but that is another huge benefit of investment properties.
Well, and guys, to that, to piggyback off of that, you may be the top 1% of people. Maybe you're not sitting there with a little bit of money. Maybe you're sitting on millions of dollars, and you would go, okay, well, Will, why in the world would I finance anything if I can go just go pay cash for something? Well, like Matt said, there are reasons why it may be a lot more beneficial for you to finance, go put your money somewhere else, while also owning that property.
Yeah, even in the high interest rate environment, believe it or not, even more so. I mean, I have a lot of partnerships with CPAs and financial planners and so forth that are telling higher net worth individuals now that, look, higher interest rate means more interest that you can write off. There's tax breaks, there's tax benefits, especially, self-employed, and that you need those extra tax breaks. Investment property and the higher rates even are not a bad thing.
And guys, another key thing that a lot of people don't know a lot about is something called a 1031 exchange. So you may say, okay, well, Will, back to your example earlier. Well, what good is it going to do for me tax-wise if I go write off all this interest and I'm going to make $1 million on something, down the road? Well, then I'm going to have to pay taxes on that. Well, there's a unique program in our industry called a 1031 exchange, which basically means, let's just say, for example, Matt has a property and he bought it for, say, $500,000. And let's say, a year from now, 2 years from now, somebody does come down the road and they rent it for the weekend and they say, Matt, we've got money and we would love to buy this place. We want to offer you $800,000 for it. Well, Matt doesn't have to take that $300,000 hit. He can put it in something called a 1031 exchange that actually allows you to take the profit and move it into a like-kind property if you go buy something else. So it's a tax deferment strategy to where you don't have to pay on those capital gains immediately. As a matter of fact, you can continue to build your wealth by rolling that into another asset.
Yeah, 100%. Couldn't have said it better myself. That's exactly right.
So guys, you might be sitting there thinking, well, I've got this money, but why would I put it in real estate versus putting it in the stock market? Well, I think on average, and again, Matt's the numbers guy, but stock market usually gets 8% a year, give or take 6 to 8%. I mean, generally speaking, isn't that kind of what the history shows?
Yes, I mean it certainly fluctuates, depends on the year and so forth. But as I had mentioned before, I mean, there's literally been 6 times in the history since the 40s that we've been monitoring this where home prices have gone negative. Well, you can't really say the same for the stock market, right? I mean, we've seen that go negative a lot, right? It's a tough game, right? Real estate over the long run, over the long term, that's why you get a 30-year term, that's why you get a 15-year term, that's why you get a longer term note on it. The longer term is always proven to be more profitable. Certainly in markets and that kind of thing can do that as well. But we are insulated in our market. Right. We are in a great market.
Yeah, well, and guys, that's part of it too, is that it's not nearly as volatile as the stock market. I mean, you might go to bed today and have all kinds of money in the stock market. You could wake up in a certain time in 2008 and you were broke, right? So with real estate, you control that asset. But just to give you an example, guys, so in March of this year, the average sales price in Blue Ridge, Fannin County, because we're talking about investment properties, short-term rentals, the average sales price was $1,040,000. Now, here's the key thing, guys. That is up 101% from March of 2023. So we're talking about a 6 to 8% gain. People in Blue Ridge just saw 100% gain in the last 365 days. So 2/3 of all net worth in America is found in the equity that people have in their homes. And that doesn't just mean primary residences. That can be investment properties or anything else.
Word of the day, word of the year, word of the month is inflation, right? Everybody talks about that around the water cooler, as they say. Well, real estate is one of the best hedges against inflation, right? You have a 30-year term, you're set, you're fixed, whatever percentage that is, whatever payment that is. Inflation over time goes up, as we've seen, gas, eggs, anything, right? Everything is affected by inflation. And that mortgage payment, if you never touch it, can stay the same and maybe goes lower, actually, when rates get lower. So wonderful against inflation because it's, you'll outpace the market when it comes to that. on top of building equity over that 30 years.
Well, and to reiterate what we said a little earlier, guys, you hear second home, you hear investment property, and you may be sitting there going, well, Will, I'm Joe the plumber and I make, $65,000 a year. I mean, there's no chance I could, own a second home or investment property. That's only for rich people. I mean, Matt, from a lender perspective, really, I mean, yes, they got to have a good credit score, but I mean, I would say, and correct me if I'm wrong, but probably one of the biggest things is if you have a substantial nest egg money-wise, you can probably make it work because you got to have money down, right?
That's right. You do have to have some skin in the game, as we say, some money down. But that can come from your retirement through your employer, traditional savings. Talked about the stock market, anything that you can make liquid from that, checking account and so forth. Also, if you currently own a home, you might. We talked about all the equity that people have gained over the last few years. Maybe we can use some of that equity to purchase an investment home.
Well, and Matt, I'm gonna put you on the spot a little bit with this question, but why do you think it is that it's so taboo for people? They hear you can pull from your 401k, and they just it's such taboo. Like, oh my gosh, we can't touch that. That's my retirement. Why would they pull from a 401k?
Well, you got to look at how your 401k is performing. Right.
Exactly.
That's really the number one thing I would look at is over however long you've been contributing to that. We talked about the stock market fluctuating. Odds are it's tied to that. How is that performing? Are you losing money? Every 401k is different, but I would advise you to look into that, see what withdrawal penalties, if there's anything like that you might incur. But taking that money and putting it into something, as we kind of showcased before, that will grow, might be a better investment than just traditionally, handing over some money into your 401k.
Well, guys, I'll give you two specific examples. One very personal. So, and this is the reason I asked Matt that question. So, it's kind of the Rich Dad, Poor Dad, book. We all think that wealth and generational wealth is built through W-2 jobs and 9-to-5s and 401ks. Guys, in a previous life, when I worked in healthcare, I worked at the same company for over 15 years, and all but maybe 1 year, I consistently contributed to. We had a 403b, but for all intents and purposes, very similar. Guys, do you know, in over 15 years, when I went to leave that field and get into real estate, I had roughly $20,000 in that account. I have another friend of mine actually that bought not too long ago, and he told me this, that he'd been with a certain grocery chain for almost 20-something years, and since we were in high school. Guys, in 20-something years of investing in a 401k, he had like $200,000 in there, which is a lot of money. But guys, when we talk about real estate, we're thinking $200,000 over a 20-something year career. You could potentially make $200,000 in the next 3 to 5 years in gains. So think about those things, and don't be, for lack of a better word, closed-minded when it comes to utilizing the assets and the funds that you have to invest in real estate.
A perfect reason to lean on the experts.
But that really is true, though. I mean, because we've just been trained that way. We've been trained to think that, that's the only way to build wealth is we got to have a 401k, and then you can't touch it. Think he's a great guy, but the Clark Howards of the world that just caution you like to the nth degree to, you can't touch your 401k, you can't touch your 401k, you can't touch your 401k. Well, we're not talking about going and buying a four-wheeler or, going on an expensive vacation. We're talking about leveraging what you have to build even greater wealth in the future.
And we can break down exactly how that would look, right? So picking out the property, the money it would take to invest in that property, to purchase that property, where it's going to come from, and then how that's going to project over the next 15, 20, 30 years, whatever it is, on top of the expected gains, even if we use just an average of yearly growth and so forth. So.
Well, and we mentioned it very briefly earlier, but Matt, speak to this. You mentioned, hey, you can use your home equity. To use my home equity, does that mean I got to sell my house to buy an investment property?
No, actually you don't. Very common way to do that is it's what's called a HELOC, home equity line of credit. So we look at what your home is worth compared to what you owe, and if there's some equity in there, you don't have to leave your home. You don't have to refinance that 3% rate you might have, or so forth. We simply take the equity portion of that compared to your outstanding first mortgage and get you what's called a home equity line of credit that you can tap into and use for really anything.
Well, and guys, again, that's where, as the experts, we come into play here, because, I can speak for myself. In a previous life where money was a lot tighter and I wasn't, where I am today, we look at debt traditionally as a way to live, cars or furniture, but guys, when you start viewing debt as not a way to live, but a way to build wealth, you'll see it in a totally different light. So there's many of you sitting there, again, Joe the plumber that makes $65,000 a year. What Joe the plumber doesn't realize is if he's been living in his primary home for 10 years, he's probably sitting on $200,000, $300,000, $400,000, in some cases $500,000-$600,000 of equity in that home. And while he's over here scratching his head about how can I start a new business, or how can I make more money, or I'm struggling, right there's his gold mine. All that money that's sitting in the equity in his home that he could be using to invest in real estate and create that wealth a lot faster.
That's right.
Even if you're not going to use the equity in your home to go buy another primary residence, I don't want to deal with these rates. Okay, well, don't go buy a new primary residence. Take the equity and go buy a second residence or an investment property and build it that way. So now you've got two properties that are appreciating.
Yeah. And maybe at some point, someone else will be paying your mortgage with the investment.
And you can become the landlords.
Right.
Think about this from a totality standpoint. You're the average Joe making, what you consider to be average income, and you're paying $3,000 a month to live in an apartment. Guys, think about it. Inside just a few years, relatively speaking, you could go from the tenant to the owner to the investor, and you could become the landlord that you used to pay.
Right.
Because if you want to build generational wealth and you want to get your feet wet in this investment thing, we know it's scary. We know that, you're not dealing with $10 or $20. You're dealing with your livelihood. You're dealing with your home. You're dealing with the equity in your home. You're dealing with your retirement funds. It's a big decision, but that's why we as the real estate experts are here, because not only can we leverage our resources, but we can leverage other relationships we have to help you make the best decisions for your financial future. And guys, let me assure you, Matt and I are not only telling you this. We've practiced what we've preached. Matt, you've owned rental property.
Yeah, I've owned a few. Yeah, land and various properties. Yeah, myself.
Yeah, and why did he do it? He did it to make money and to position your family better for the future. Guys, same way with me. When I got into real estate, it took me a little while, but now, I'm building some spec homes. And matter of fact, I was just talking to Matt before we sat down to film, and talking to him about the prospects of me actually buying a short-term rental up near Chattanooga. So guys, we're telling you this because it works. We're telling you this because we've seen it in our own lives. We've seen it in the lives of other agents. Matter of fact, Matt and I have a good friend that's in our network. Guys, 30 years old and owns 50 some odd investment properties, and literally is a multi-millionaire in his early 30s, not because he's just a real estate agent, but because he has taken that knowledge and he has invested in real estate. Guys, I'd say the vast majority of realtors I know, probably a lot of lenders that everybody's doing this.
Yeah, I mean, we see it so much that we not only do it, we live it, right? It really time and time again, doing this for so long, you see, wow, what's the majority of people? I've seen teachers that have net worths of $1 million plus because of the real estate they've accumulated over the years.
And so, guys, I would leave you with this. As an expert in the financial industry, Matt, you probably see people all the time that have thousands of dollars a month in Tahoes and vehicles and depreciating assets. Mm-hmm. What would happen if people would stop focusing on what they drive and stop focusing on that $1,000 a month towards a Tahoe and focused on $1,000 a month towards a second home?
Yeah.
Investment property.
In case we had any car dealers listening, that's
Sorry.
I love cars. I love cars. I love them. But exactly, it's just like everything, they're very expensive. But when you talk about a $1,000 car payment, $1,300 car payment, which I've seen, and if you put that to a home, an investment like that, you're going to grow that money instead of losing that money. So,
guys, at the end of the day, what we're trying to tell you is you're not as far away from becoming the next Barbara Corcoran or becoming the next huge real estate investor. You're not that far from it. Many of us and many people we know, they started with hard money loans. They started with borrowing money from mom and dad. They had to borrow money to create that wealth. But guys, the good news is you are not as far as you think you are. So guys, ultimately what we're trying to do is we're trying to dream for you. We're trying to help you see real estate through our lens, because we've got other clients who have created wealth and have created tremendous wealth through these avenues that we've helped. We're trying to help you see the same vision. So the first thing you need to do is apply with Matt, see where you're at. Matt, how can they apply with you or get a hold of you?
You can reach out to me anytime, whether it's call, email, text, anything works. You could drop by our office in Canton. Love to see you. But the first step is reaching out to me. And speaking about rates and where they are right now, yes, they're high. And, we believe they'll come down. And we're so confident that they will, and they eventually will come down, that we, as a client with us, we give you literally after closing, a 5-year certificate that says anytime in the next 5 years, when rates come down, you hand in that certificate and we will waive our fee to refinance with us. So you get 5 years for that from the time of closing. Now, you actually don't really need to reach out to us. You're going to be in a system that tracks all that stuff for you with us. It's part of our process that we have. So odds are I'll be telling you, or I'll be reaching out to you with when the right time is and so forth. But the idea with that is we're going to take care of you. Yeah, you talk about wealth building. This guy I lived with right out of college for a little bit. We kind of lost touch for long time. He got into real estate slowly, is a multimillionaire now because of the properties that he's bought and rehabbed and sold and rented out and built and et cetera, et cetera. So,
well, and dude, what's crazy is, when people think about flipping or making money, they think, okay, well, I've got a car I bought for $2,000. I'll go sell it for $3,000. I made $1,000. What people need to understand is with real estate, you're not talking about $1,000. You're not talking about $20. You're not talking about $500. I mean, you're talking about tens of thousands of hundreds of thousands of dollars. I mean, you're not, and no disrespect to these side hustles, but you're not talking about, selling items at a flea market, or you're talking about what you make in a year making in one deal.
Yeah, everyone sees these clips on the TikToks and all this stuff where you can make all this money being a affiliate, Amazon affiliate or whatever. You see the influencers is what I was looking for. You see all these people, but I mean, come on, how many people actually do that, right? The general public. But the reality is almost 70% of wealth is built, personal wealth is built through real estate. That is a lot better average than an influencer on Instagram or TikTok or whatever avenues these young kids are doing now.
Man, I got a client who he's a builder, local builder, contractor, and just out of the blue, reaches out to me one time. This was a year and a half ago. Well, we want to flip one here and there. No experience flipping, no nothing. I mean, never done anything except buy his primary home. And literally within two transactions, he had made over $100,000 inside of a year. I mean, just off of flipping two houses. And I think he made 65 on one, and I think they made, around 40 on the next one. Just, hey, I want to flip a house. And, 6 months later, he's made $100,000. And guys, our whole purpose is to help you think bigger as it relates to real estate investing. I know we've said it multiple times, but we want to say it again. It's not as far from you as you think it is. There are so many avenues. There are so many streams. There are so many different things out there that can help you achieve that goal. There's obviously the lending route. There's all kinds of other people that are waiting to partner with you and to invest and so forth and so on. So guys, dream bigger, think beyond where you're at currently right now. You know, you're not crazy about the money that you make right now. We all want to make more money, but maybe you're clocking in 9 to 5. You know, you're making what you consider decent money, but you have all these dreams, you have all these aspirations, you have all these ambitions. Guys, what if all that started with one call to me and Matt and your real estate professionals, and we lay out a plan for you, you go with it, and in 5 years from now, you're sitting here coaching people, telling them the exact same thing because all you did was make a call.
Journey of 1,000 miles starts with one step, right?
Yeah. So guys, as you can see, your dream of becoming a homeowner or investing in real estate is not as far off as you might think it is. Your dream can become a reality. Take that next step and reach out to Matt and I, your local real estate experts, and let's get the ball rolling for you.